Do you want to know why nobody's looking to buy a house right now? Or maybe better put, why nobody's pulling the trigger when they are looking? It's because they can't afford the payments. And the first thing that people need when buying a house is to be able to afford their payments. I'm Josh Bickford. This is the inBLOOM podcast. We are coming to you live right now on YouTube, Facebook, and LinkedIn. We will be available in a couple of hours on the audio streaming platform of your choice. It is Monday morning, and I am going to show you how you can get around the problem of people not being able to afford a new home. And it's simple. It's an assumable mortgage. Assumable mortgages let you take advantage of those 3% rates, those 2% rates, those, maybe even up to 4% rates that people could not buy fast enough, and skip the process of looking for those 6.5%, 7% interest rates. Maybe by the time you see or hear this, even higher. Skip that process altogether. So we're going to go through 8 deals. Quickly, I'll show you a picture of the house. We'll just use the Zillow page. And I will show you the difference between assuming the mortgage and what it would cost per month to buy these houses at 6.75% with a 20% down payment. Worth noting on each of these, none of them need a 20% down payment. So you save every month, you pay the note off faster, and you need less money up front to get it done. It is a win-win-win for everybody. It is the way around the problems we have in the real estate industry right now. And because there is so much less interest that's required of these, it makes all the sense in the world to buy one right now. So let's get started. Our first house here, you can see, is pending at $760,000. The interesting thing worth noting here is where it's pending and the current loan balance. It's 104% of the price. So in this example, it would theorize that the seller would need to pay you money, assuming you're not pending over list. If you wanted to put a 20% down payment, this would cost you a shade under $4,500 a month. If you assume the current note, it's $3,772. And that's not putting any money into it. Probably going to be able to find, it's a lot of money. It's an expensive house, obviously, but you're probably going to find more people who can put nothing into the house up front than you are that can pay 20% down on a note that size. Our second deal, this one has a 98% loan balance to purchase price here. So we're pending at $479. Loan balance is right there. It's at 3%. If you put a 20% down payment on this house at 6.75%, you're at $2,886. And if you assume the mortgage, it's $2,450. So you basically need 2% down, and you would save over $400 a month. And the other one, you're putting 20% down. So what if someone's looking for an FHA note? Obviously, way bigger. There's no mortgage insurance or any of that kind of thing. Our next house here, you can see, pending at $468. The note balance is a shade over 96% of the purchase price. So what you're looking at here is basically an FHA down payment. If you put 20% down, it's just under $3,400. And if you just assume the note, it's $2,736. And this one, it's worth noting, has a note that's over 5% that you can assume. So that's not even like one of the really attractive notes, and the savings is massive. I'm going to pause here to talk about coffee, because this podcast is a conversation on thriving in life and real estate over a cup of coffee that we do Monday through Thursday at 9 a.m. Mountain. Better coffee today than last time. So this is from New Mexico. It's fantastic. Very chocolatey. Next up, want to get to these quickly. Again, 15 to 20 minute conversation. I don't want to spend all day going over numbers and numbers and numbers. I wanted to zoom through these with you to show you the abundance of the opportunity here. I've been saying for a long time, These are how you are going to thrive. These are the end around to all of the nonsense that we see in our industry, with people acting like a small uptick on the backside of a collapse is this huge gain, that interest rates drop 0.1% and everybody acts like it's the buying opportunity of the century. No, assumable mortgages are the buying opportunity of the century because these are the minority of deals. There's a ton of them. Something 25, 30, 35% of all mortgages are assumable, FHA, VA, or USDA notes. So you can absolutely build your business around these. They are not the opportunity that everyone pretends everything else is. These are the actual opportunity right now. This is the pier around the corner. The rest of 2023 into 2024 into 2025. These are where the action is going to be. People are going to want these first. These are going to sell the fastest. They're going to sell for the highest price. If you go back to Friday's podcast, or it's not Friday, excuse me, Thursday's podcast, we have an example of what this looks like from Las Vegas, where we've got an active that's not assumable at 370, a pending assumable at 448, a pending model match in the 390s, and a house that's pending that's 400 square feet larger in the 390s. The 448 is the assumable deal. The other ones are not. People chose 448,000 over 370 because the payment was so much less. The assumable went pending in 2 days. Everything else, the active is at 190 days. What's more now, because that was last week. The pendings both took more than 200 days to go pending, and the assumable was 2 days. So opportunity is huge. So next one here, you can see this one's got an assumable 3.75% note. The note is 95% of what they're pending at. This went pending the day they put it on the market. And if you put a 20% down payment on this, it would still cost you 5% more, or excuse me, $500 more than if you made a 5% down payment and assume the current note. $500 a month every single month. And 15% of that price, which you can see here is a lot of money. You can keep 15% in your pocket and still save $500 a month. Awesome. Next here, this one has a 93% percentage of the current loan balance to the purchase, or where it's pending. You know, like we don't know where these are going to land, obviously, because they're just pending at this point. But this one, if you were to make a 20% down payment on a new origination, this home would cost you, let's do the math here. Is that $600? $620 more per month. So you would save $620 every single month. You're only putting 7% down, not 20, and you're paying the note off faster. Our next example, this one is 92.3%. And the theme here with all of these is it's less than a 10% down payment, which is where most people land. When I was a mortgage guy, 10% kind of seemed like the sweet spot where people liked putting that amount down. Your market might look a little different. You know, you could be in an area where everybody wants, you know, FHA notes at 3.5% down. Well, all of these could work for that because the 3.5% down, if you can negotiate the price correctly, which will get tougher the more that people figure out these assumable notes are where it's at. But if you could negotiate, you know, if you've got a 92% deal, if you can get 3 or 4% off the price of the house, you're right there. 3.5% down payment, bam, save a ton of money. It is absolutely awesome. So where were we here? We were at, this one's got a 2.87% assumable note. If you put 20% down and got a conventional mortgage at 6.75%, it would only cost you $520 more per month to go that way than to assume it. Next up, this has got a 3% assumable note. It's got 92% loan balance to where it's pending. If you wanted to put 20% down, and this one's a really good example. If you put 20% down and you got a conventional mortgage, it would be a shade under $3,600. If you assume the current note and put 8% down, It's a shade under $2,700. So you're only saving a little more than $900 per month to put less money down and assume the current note. And our last one here, you can see here we have got another very expensive house. If you put, this one's got a 91%, so figure 10% down here. If you put 10% down and assume the note at 2.75%, you're going to spend $37.77. If you put 20% down and you secure a 6.75% note, you're going to spend $42.08. So a little more than $400 more a month to make a bigger down payment. Those are obviously big numbers. Those are big houses. I like that because it shows you that there's a variance within the market. Here in Colorado, it's ridiculously expensive, like ridiculously expensive. I do not understand why people want to pay this much for houses in this market, because it's not like, I mean, you have really good views of the Rocky Mountains, and the weather here for all 4 seasons is pretty awesome. We don't have humidity, and you sit outside every night all summer long, and it's just perfect. You sleep with the windows open, all of that stuff. Awesome. But you're not looking at the ocean. You know, you're not, Denver is not, and Colorado Springs and wherever else we are. Like, none of that's the weather that you get in California, or it's not Florida. Or it's like, Colorado's never been a really super expensive market. That happened because interest rates got so low, not because demand increased. In fact, Colorado has become, when I moved here in 2021, it was as a state where people were flowing in. It has become one where people are flowing out now. Colorado's actually shrinking in population. So wanted to go through these and just make a couple of points with you. So let me take another sip and we'll get back to it. There's a lot of fear in our market right now. There's a lot of people that don't feel prepared for what's coming. They are afraid to try to look at what is next, and they're busy trying to cling to what is gone. And you don't need to do that. Absolutely do not need to do that. I believe personally that the opportunity ahead of us is bigger than the opportunity that's behind us. That may have been the easiest time in the history of real estate to be a real estate agent, and what's coming is not going to be easy. However, you are going to be able to set yourself apart. You are going to be able to provide service that no one else can. You're going to be able to impress and become a pillar of your community, become someone that the real estate market in your city is built around. That opportunity is sitting there right in front of you. That is what is coming. We are going to see interest rates continue to rise. We are going to see economic conditions worsen. We're going to see a deflationary market in most markets. Where you're at, if you want to know what that's probably going to look like, take a look at what your market did from 2019 through 2022. If your market was pretty flat, you're probably not going to see a massive correction. You're going to see some because affordability comes into play, but you're not going to see, what we've seen in Colorado here, or what Phoenix or Austin or California has experienced, or Seattle. The Western U.S. really took off in that window. And they have seen that they were the earliest to correct. They have seen the steepest corrections, even in some of the smaller markets, in parts of Utah and Idaho and different places where, especially where people fled California and went to more affordable places and then drove the price beyond what the locals could afford, which happened here in Colorado. The correction is happening, and we're in that. These assumable mortgages are a gift because those payments that could be afforded, even though the price wasn't, are still accessible. And in your market, if you're looking and everything you've seen that's assumable has a huge gap, well, you can get a second mortgage. You can get creative with that because the loan is not re-underwritten. You have to prove you can afford the payment, and you have to prove that you can that you're creditworthy. Past that, it's much more creative in how you can put these together. They have to be owner occupied. And you need to be honest about everything. You're not going to go lie and cheat and steal and put yourself in prison over these. That'd be crazy. But the opportunity is huge. You've got 8 examples here. Last week, we talked about buying multifamilies using this and moving every year or so. and how you could, over a 5-year time, if you did that with fourplexes, you could have 20 units that are on track to be paid off, in a little bit more than 20 years. That's a huge opportunity. That's lifetime wealth. That's stuff that you can pass down to your children, done in a very easy way. It's an amazing opportunity. The theme of our discussions here, the theme of these conversations, have been not to be afraid of tomorrow, to peek around the corner and take a look at what's coming, to embrace it as the opportunity that it is, and to go get it, make it happen. That's why you're here. That's what you've been looking for. That's why you and I sit down 4 times a week and have a conversation on what it looks like for you to thrive moving forward. I'm so glad you came. I'm so glad we get to spend this time together every day. And I can't wait to see you tomorrow. Be sure to like if you got value out of this. Share it with a friend. If you're not subscribed to the podcast or to the channel, or we're not connected on social media, make sure you do that. Let's get connected, stay connected. We're going to pour into your life and into your business, and we're going to see you realize your dreams over the next few years in a way that you can never imagine. So glad you made it today. As always, I hope that when this day ends, you look back at it and realize it was one of the best days of your life. God bless.